Hello everybody, my name is Mark. Welcome to this video on investing and stock options. And in this video we are going to go over the fourth level, the highest level of option trading. Once again, you cannot just buy and sell stock options. You have to get approved by your broker. And this is TD Ameritrade. The way you do it is you go to Client Services, roll your mouse over here under My Profile, click on General, and then come on. And then over here you go down to option trading, click on apply for upgrade, and here you put in all the information, put your name, put in what level do you want. There's 4 levels, level 1, 2, 3, and 4. You put in all of this information, growth, whatever, your employment status, all the address, occupation, everything, and then you put in how much money do you have, the average transaction size, number of transaction per year, stocks, bonds, options. Of course, you're going to click that box, and then you click on the agreement, and then you click submit, and then you're off and rolling. And it takes about 3 to 5 business days to get approved. And in this level, I'm going to go back here. So again, in this level, we are going to go over the highest level. It's the 4th level of option trading. They call it Tier 3 Advanced, but there's 4 levels. The first level, we did a video on that, was writing covered calls, writing cash secure puts, where you're the option seller and you sell call options and put options to the open market and you are compensated for that transaction. And then level 2, where you become the option buyer and you can start buying and selling call options and put options. And then the 3rd level, you need a margin account and you can create spreads, and we talked about that a little bit. And there's really a lot you can do with spreads. And in this level, we're going to talk about the highest level, where you're writing uncovered options. Okay, this is a very good video for me to do, because this video is the first video that I'm doing where I'm actually going to talk about the kind of risk that you take when you invest in stock options. When you buy stock, the risk is that the value of your shares will go down and you'll lose money that way. But when you buy stock options, the kind of risk you take is totally different. So this is level 4 option trading. And in this level, you get everything that you get in the first 3 levels. You can write covered calls, you can write covered puts, purchase options, create spreads, and finally, and this is why it's the highest level, you can write uncovered options. And the key word there is uncovered. It means you're not covering your positions, and so that's what makes it risky. And so I'm going to explain what that means. So we're going to go back to a stock here that I've talked about in other videos, and we're going to hit Tesla. Okay, now Tesla, if you look at the chart, it's a high-flying stock, and in the last year it's done very well. It just in last December, you can see here it was down here at the $200 level, and now it's all the way up to the $300 level. So that's a very nice return on your money, almost 50% gain. So let's say you like Tesla and you think it is a good stock. Well, what you might do is you might write an uncovered put option on Tesla. So if you wanted to do that, you go to the option chain, and it looks like maybe you want to write the uncovered put option. Let's say you want to play it safe and you want to put it like down here somewhere. Okay, so right now the price of Tesla, it looks like it's trading at $308 a share. And let's say you want to put the put option strike price below these last levels of support. So let's say $235. So let's look for a good put option. So let's go out a few days so we can get some premium. Let's go out, let's check September. Actually, let's start with July. Let's start with 77 days. And again, we'll look for in the money put options and click on in the monies there. Oh, I'm sorry, they're actually out of the monies. Sorry about that. So go to out of the monies. Here, view the chain. And now let's look at the 240. So it looks like for the next 77 days, the premium that you could get on a put option is the bid is $210 and the ask is $255. Okay. Now, when you're writing a covered put option, then you would be setting aside the money to cover the price that you could, or I should say that the other party that you're selling the contract to could sell the shares to you if the shares got put to you. Okay, a put option is a contract to sell shares of a stock at a preset price, and this is $240 a share. This particular put option, as you can see, there's all different prices there, and by a certain expiration date, and we're looking at 77 days that the contract expires. And these put options are worth money, and that money is called the premium. And it looks like the bid is $210 and the ask is $255. So when you sell a covered put option, which is the lowest level, it's not risky in terms of the options, that's why it's the first level, then that means you have $24,000 in your account to buy 100 shares of Tesla stock if the price of Tesla stock dropped below $240 a share or lower in the next 77 days. Okay, but in the highest level, you're going to write an uncovered put option. Okay, so in order to write an uncovered put option, that means you're not setting aside that money, and so you have to know what the margin requirements of your broker is in order to be able to do that. Some brokers, it might be 25% or 20%, and you have to know what those requirements are, because if the stock goes the wrong direction, then you will be forced to sell your stock and get out of the position because you will be outside the limitations of the margin requirements, and so that's what makes it risky. And so the risk that you are taking when you are the option seller, okay, on the last day, 77 days from now, that put option is going to expire, and when it expires, that put option is going to automatically be exercised, which means you will automatically have to buy the shares, 100 shares of Tesla stock on the day of expiration if the price of Tesla goes to $240 or lower than the price of that put. Okay, and so if you think about it, okay, if you sell a put option to the open market, that means somebody else, you are giving somebody else the right to sell you 100 shares of Tesla stock at $240 a share. So if Tesla was at, let's say, $250, then of course, you know, nobody would want to sell you Tesla at $240 a share when it's worth $250 a share. That would be an instant loss. Okay, but if the share price of Tesla is below it, let's say it's down to $230, and you sold a put option to somebody, then that person may say, you know what, I'm going to use my option and I am going to sell you 100 shares of Tesla stock at $240 a share, because the price of Tesla is only worth $230 a share. So they will instantly make $10 a share. So the value of that put option on the day of expiration would be $10. It'd be worth $1,000. Okay, and so that's the dream of every option buyer. So every option buyer needs an option seller, and so you have made a decision to be an option seller, and you have level 4, and you're going to sell an uncovered put option. Okay, in the case of a covered put option, if that were to happen, well, you have $24,000, and all that would mean, and even though you'd be getting ripped off, at least you have the money to cover yourself, and you could buy the 100 shares of Tesla, and you don't have to worry about getting a margin call. Okay, but in the case of an uncovered put option, you might get a margin call, and if you don't have the money, then you would be forced to liquidate your shares, and your broker would ask you, where's the money to cover this position? Okay, so let's click on the option. Let's say you want to do that. Okay, so you click here and you want to sell to open because you're the option seller and you are opening a new contract. Okay, and maybe you want to try to get it in the middle somewhere. Let's put 230. Okay, and we'll do one contract, and this is uncovered, okay? And right there you can see you get $230 credited to your account, okay? And I'm not going to place the order, but if you were to click place the order, then I'll go back to the option chain here. For the next 77 days, okay, you would have a position in Tesla, and it would show a negative sign, and it would be a short position. If you were the option buyer and you bought the put option, it would be a long position, but you are going short, and you are shorting Tesla. And again, I'm going to go to out of the money here so you can see the option right here. Okay, and so for the next 77 days, your dream is that Tesla stock will not go below $240 a share or lower. But the key is it is an uncovered put option. We're talking about the level 4, which is the highest level. So again, let's go back to the client services, click on my profile, the general, apply for upgrade, and it is writing uncovered put options. So that's the difference between writing covered cash secure put options and writing an uncovered. In the case of a cash secure, you have the $24,000. I'm going to go back to the stock here, so we're not talking out of our memories. And I'll go back to the $240 put option, which is out of the money. Okay. So in the case of selling a cash secure put option, you have $24,000 in your account. So you simply sell this put option to the open market, and for the next 77 days, you just make sure that you don't touch that $24,000, and you can hold on to that put option safely, that short position safely. But in the case of an uncovered put option, now you don't have the $24,000, and so what could happen is that if Tesla went below $240, you would start to lose money, okay? Because if it went to $235 on the day of expiration, you will be obligated to buy those 100 shares of Tesla stock from the option buyer at $240, but the shares of Tesla will only be worth $235 a share, so that's an instant $500 loss. Now, in the case of covered put option, you don't have that same concern, okay? Because you can just buy the shares, and then you'll just own 100 shares of Tesla, okay? Now, let's say you were to do it the other way around. Let's say you were to sell a covered call, okay? So let's go to covered call here, and in the case of a covered call, you are buying. The first thing you do is you buy 100 shares of Tesla. So Tesla would be, it looks like the last price is $308.35 a share. So you would need $30,835. But let's say you have that money, you buy 100 shares, and then you could sell a covered call. Let's say at 300 and let's say you give it a 5% margin here. So let's see, 5% of 308 would be half of 30, so about $15. So let's go up to, let's see, 308 plus 15, 323. So let's go up to the 325 call price here, and that would be a 5% markup there. So look at that. That's very high premium there. So if you had the money, you could buy 100 shares of Tesla stock for $308. You have $30,835, and then 77 days. Look at the call option, 77 days out. Click on the 300, and you would get $1,260 premium. Okay, and that's for 77 days. So let's see, 1,260. Let's see, I'm trying to figure out the percent. That's about a 4% return on your money in 77 days. $1,200 would be 4% of $30,000, and not counting if it went up 5%. So you could make a possible 9% return if you had $30,000 and you bought 100 shares of Tesla and you sold a covered call. Okay, and then if the price of Tesla went past 325, let's say it went up to 330, you would not lose any money on the premium of the stock option, because even though the value of your stock option would increase, the value of the 100 shares that you own are also increasing, which would offset the loss that you would take on the shorted position of your call option. So that's why selling cash secure puts and selling covered calls are the first level, and they're safe. You cannot lose money on the premium. You can only lose money on the stock value itself. But if you were to sell an uncovered call, then that would just mean that you just click on this call option, you sell to open, and you open a short position on this call option, and you don't own the 100 shares. So that if Tesla did go up, let's say it went up to $330, what would happen is you are selling a contract to somebody else to buy those shares from you. So if on the day of expiration the price of Tesla is higher than this $325 strike price here, and it goes up to $330 on the day of expiration, you would instantly lose $500. And if it goes up there that high before, then your broker may have margin requirements, and you may get a margin call. So that's why selling uncovered calls and selling uncovered puts are the highest level, because that's where you really take on some margin risk. Okay, so if you're going to do that kind of investing, I'm going to close this out. I'm going to go back to the client services, go back to the general, go back to apply for upgrade. If you're going to do this kind of investing where you have a margin account and you write uncovered options, then you really need to know what you're doing, and you have to be very good at managing your risk. You don't want to just do something like this willy-nilly, because you could lose substantial amount of money doing something like this, and you could even lose more money than what you have in your account. So you have to be careful with something like this. You have to be very good with risk management. And so that's a little taste of level 4 option trading. So that about does it. So now I've gone over all 4 of the levels. So if you want to be an option trader, if you want to invest in options, you start with level 1. Okay, get approved for that. It's very easy to do. As long as you have a job, you're going to get approved. And then for a few months, just sell covered calls and sell cash secure puts, and do that for a few months, and then go up to the next level, get level 2 approval, and then start buying calls and buying puts. Get cheap calls, cheap puts. Don't spend an arm and a leg. Keep an eye on your investments, and then when you're ready, go up to level 3, where you can create spreads, and that's really where the fun begins. That's where I think the fun begins with level 2. I enjoy buying calls and puts, and I've done okay doing that, but when you're able to create spreads, that's where you can even have more fun. And there are lots, and I mean lots, of videos, and there are tons of different methods and strategies you can do with spreads, with options. You can buy a call option at a $50 strike price and sell a call option at a $55 strike price. You could vary the expiration dates. You could do it with puts. You could do a call spread and a put spread. And there are strategies known as iron condors and butterflies and ratio spreads, and all of these different strategies that you can do with options. And then if you want, and I really think that you should be very good at risk management, stop loss orders, and don't get in over your head. You can make money writing uncovered calls and puts. A lot of people like to short straddles and strangles. Straddles is where you're defining your risk, but you're doing it uncovered like, and strangles. And there are videos on that, and people like to do it around earnings when the volatility goes up and the premium price of the option goes up. People like to try to make a quick buck on that premium and that volatility. So start small, work your way up step by step, and eventually maybe you can play with the big boys and do all of those higher level option trading strategies. So that's it for this video, and that's it for the 4 levels of option trading. Thank you for watching. If you have any questions about any of the videos that I've done, please leave it in the comments section, and I will see you again. Thank you.